Well, President Trump's tariffs roiled markets this week, and the ever-changing trade policy poses issues to a lot of retailers scrambling to navigate more complex supply chains, higher costs, and challenged consumer markets. As a result, investors shifting into risk-off mode. So here to discuss the impact on retailers, we've got Simeon Siegel. He is BMO Capital Markets Managing Director. Simeon, we're going to talk about some individual retailers in the space, but first just tell me how you're viewing the totality of earnings prints from retailers this quarter and what you're expecting in terms of the impact from policy.
Yes, hey, Madison, great to see you. So I think that right now you're in, Brooke said it perfectly, this notion of risk off because of what things are going with eggs translates into the rest of consumer. But I think the most interesting dynamic that we're seeing from an investor is this risk off simply because the market is very hard. And that sounds very simplistic, but right now you're watching a lot of people look at these companies and see a mismatch between performance and what is going on. And so for most of my investor conversations, people are just nervous to make a bet. And they would much rather pay up for something they perceive to be quality than actually start looking down in the dumps, so to speak, for a value dislocation. And normally you have people that chase growth and momentum and are willing to pay up, but you also have a strong value investor that's willing to go and find underappreciated opportunities. Mm-hmm. I can tell you from my conversation, there are not many people willing to pick up the phone for a value opportunity right now.
That's really interesting and it plays into our broader conversation, Simeon. I want to get into some retail superlatives with you for this moment of such volatility. Some of those perceived safer names for investors, including some of your most comfortable picks. What are some of those stocks?
Yeah, so it's funny, right? Because I'm supposed to be intellectually honest. I'm supposed to look at things and say things are supposed to have an intrinsic value. And on the other hand, we can see, you were just talking about Costco. Look where Costco is trading. Mm-hmm. We talk about TJX in my world. Look at where that's trading. Like there's companies, Planet Fitness, which are just excellent businesses. They're businesses that'll continue to compound. They're businesses that honestly shouldn't have much in the way of surprises vis-a-vis their business. But you and I need to be okay paying for effectively valuations that we have never seen. And so those are the businesses on the, let's call it the right side of my barbell, where I'm just looking for good compounding businesses, where if I'm thinking about the risk framework, if I'm using your superlatives, I have businesses that I'm taking risk on the numbers, on the business, and I have businesses I'm taking risk on the valuation. TJX, Planet Fitness, I'm not really worried about the business. I would have to be taking a risk on the numbers. So that's my right side, good, expensive for a reason companies, TJX, Planet Fitness. The other side, so if I'm looking at businesses that I think are less risk to the multiples because they're so heavily compressed, but I'm willing to take the risk on the business, I think there's some really interesting opportunity. I think there's a host of those. And I think the number one for us right now is Capri, which owns Michael Kors, Versace, and Jimmy Choo, where I think there's interesting balance sheet opportunities, and I think there's interesting company fix opportunities. But I will say, right now, there's just not that much of an appetite for it, which again begs the Buffett question of at what point are we supposed to be fearful and what point are we supposed to be greedy?
And I'm fascinated in those picks because you can dive into each and get a completely different story about the state of the economy and the state of the consumer. For the TJX and Planet Fitness picks in particular, is there a concern to be had about that mid to lower tier consumer who might have to trade out of those names if the economy slows further?
So I think it's an excellent question. I'm glad you brought it up. If you look at the average revenue, so if you look at we're almost done. It's ironic. We're in March, but we're still reporting Q4 earnings from last year. We're almost done getting the Q4 earnings. If you look at the companies that reported Q4 earnings on the consumer discretionary side, Staples is a little bit different, but on the discretionary side, not large. The average company is actually posting revenue growth of around 5%. That's really good. Right. And then we can talk about price versus units, but that's actually the consumer is still spending. And so there's this big, broad boogeyman fear of macro and tariffs, which I'm sure if we want to probe into, I've used there too, which we can talk about. But companies are actually still outperforming, or they're performing nicely, and they're doing it on healthy gross margins. And so we have this rhetoric of where are people shopping, which type of people are shopping. But what we're actually seeing, I think, is we're seeing market share conversations. We're seeing winners and losers within each group. And so that's one point that I think we need to stress, that I do think the underlying trends of businesses are actually healthier than they're seeing. And I think the second Venn diagram bubble that I would throw out, not every company, most companies that reported that saw their stocks get hit the most recent weeks, they didn't actually complain about their results. They were worrying and they were cautioning about the guidance.
Right.
Is that going to be conservative? Is it not? Is another question. But so to your point about TJ and Planet, I think that TJX, more so than maybe other off-pricers, actually has a very diverse income strata. It's not just discounting. TJ is not optimizing for price, it's optimizing for value. It's trying to give a great offering. It gives brands a good place to sell their products. And so I think even in the scenario that you outlined, I think TJX still benefits. Again, I think that I would caution against saying the lower income consumer is not shopping. I don't know if I would hear that. But even within that scenario, I think TJ still wins.
So, Simeon, you made me think of something I've just been personally wondering about, which is who is best positioned to handle the impact of tariffs. And I've wondered if we're going to see a return to favor for some of the big box retailers that have these iron balance sheets, the likes of Walmart and Target, which obviously are struggling off of their earnings. But when you compare to some of these direct-to-consumer brands that have grown in popularity, kind of the Instagram companies, are the big box retailers just better positioned to handle the overwhelming uncertainty that's coming from policy right now?
So I think it's a beautiful question. If I can reframe it slightly and say, I think what you're asking is, are the healthier companies better suited to be healthy? And the answer obviously is yes. I've completely oversimplified your question and made it sound silly. It's not what I mean to do. But I think the point is tariffs. And I think you're getting at a very important point. What are tariffs, right? Ignoring and removing, and I'm not an economist, and I'm sure economists will tell me I'm wrong, and they're much smarter than I am, so we'll take that as the caveat. But what are tariffs? Tariffs are a cost input that goes up. The same way that cotton is a cost input that can go up, wage can go up, supply chain, shipping and handling can go up. When a company faces a cost input that goes up, they deal with it. And the companies that are best suited to deal with it are the companies that, one, have the best brand equity and can therefore take the most pricing to try and offset it, because that's the easiest way to do it if you're able to. The other scenario is you find other savings. You cut other costs. And so what that means is it's who can deal with costs going up. Well, the best situated companies, to your point, having a fortress balance sheet helps you work your way through it. But you need to be able to absorb the cost. You need to be able to figure out a way to pass it on or save elsewhere. That just means, are you a good business? The problem, in my opinion, with tariffs right now are dramatic. It's the uncertainty of the tariff, dramatically more than the severity of the tariff. Companies don't know what problem they're trying to fix. Are they supposed to take their China supply chain and move it to Mexico, as they may have done a few years ago? Well, that wouldn't have worked. Are they supposed to move it to another country? And I think that this two-step, this inability to say, here is the problem, I know the problem I'm trying to fix, I think that's what's creating all the uncertainty and the volatility. Once they know what problem they need to address, their companies, the best companies, will be able to address it. Others will feel pain. I don't mean to belittle it, but at least they'll know how to proceed.
Yeah, I really love the breakdown. Is a healthy company healthy? And the answer is yes. Simeon, thank you so much for joining us and breaking all of that down. Appreciate it.
Great to see you.